Welcome to the Finance Savvy, your trusted source for all things personal finance, wealth management, and financial wisdom. Here, we believe that financial success is within everyone's reach, and we're here to guide you on your journey. Our channel is designed to empower you with the knowledge and strategies you need to make informed financial decisions. We provide tips, tricks, and insights to help you achieve your financial goals, whether it's budgeting, investing, or planning for the future. Join our growing community of financial enthusiasts. Subscribe now and ring the notification bell so you never miss our valuable updates. At the Finance Savvy, we're dedicated to making your financial dreams a reality. Let's embark on this journey together. Welcome to a segment where we'll explore two powerful tools for managing debt consolidation and refinancing. These strategies can help you simplify your debt and potentially save money. We'll delve into when and how to use these methods effectively. 1. The power of debt consolidation. Debt consolidation is a technique that combines multiple debts into a single, more manageable loan. Here's why it can be so effective. 1. Streamlined payments. Instead of juggling multiple payments, you have one monthly payment, making it easier to stay on top of your debt. 2. Potentially lower interest. Depending on your creditworthiness and the terms of the consolidation loan, you may secure a lower interest rate, which can save you money. 3. Psychological relief. Debt consolidation can provide emotional relief by simplifying your financial situation and reducing stress. 2. When to consider debt consolidation. Debt consolidation isn't a one-size-fits-all solution. Consider these scenarios when it might be the right choice. 1. Multiple high-interest debts. If you have multiple high-interest debts, such as credit card balances, consolidating them into a single, lower-interest loan can save you money. 2. Struggling to manage payments. If you find it challenging to keep track of numerous monthly payments, consolidation can simplify your financial life. 3. Improving credit score. If you have improved your credit score since initially taking on your debts, you may qualify for a better interest rate through consolidation. Here's a question from the audience.
On this statement above, quote, multiple high-interest debts, if you have multiple high-interest debts, such as credit card balances, consolidating them into a single, lower-interest loan can save you money, unquote. Especially consolidating them into a single, lower-interest loan. So, are the banks consolidating your multiple bills? And how do banks make money by getting lower interest rates on the loans?
When we refer to consolidating multiple high-interest debts into a single, lower-interest loan, it typically involves a financial strategy that individuals can use, often through financial institutions like banks or credit unions, to simplify their debt repayment and potentially reduce the overall cost of borrowing. Here's how it generally works. 1. Debt consolidation loan. Individuals apply for a new loan, often called a debt consolidation loan, which carries a lower interest rate compared to their existing high-interest debts, for example, credit card debts. This new loan is used to pay off the existing debts in full. 2. Lower interest rate. The key advantage is securing a lower interest rate. Credit cards usually have high interest rates, while a debt consolidation loan typically offers a lower, fixed interest rate. By consolidating, borrowers can reduce the total interest they pay over time. 3. Single monthly payment. With multiple debts paid off, the individual is left with a single loan to repay. This simplifies their financial life, as they only need to manage one monthly payment, which can make budgeting and tracking finances easier. 4. Saving money. By paying a lower interest rate, borrowers can save money over the life of the loan. This can result in lower monthly payments and quicker debt repayment. Banks and financial institutions profit from debt consolidation in several ways. 1. Interest income. While the interest rate on a debt consolidation loan is lower than that of high-interest debts like credit cards, the bank still earns interest income on the new loan. The lower interest rate benefits the borrower, but the bank still makes a profit. 2. Origination fees. Lenders may charge fees for originating the debt consolidation loan. These fees contribute to the bank's revenue. 3. Increased customer loyalty. By offering debt consolidation services, banks can attract and retain customers. Customers who successfully consolidate their debt may choose to continue their banking relationship with that institution. 4. Reduced default risk. Lower interest rates and simplified repayments can reduce the risk of defaults, which is beneficial for banks. It's important to note that the specific terms and conditions of debt consolidation can vary, and the benefits depend on the individual's financial situation and the terms of the consolidation loan. The ultimate goal is to help individuals manage their debt more effectively and potentially save money on interest payments, making it a win-win situation for both the borrower and the financial institution. 3. The refinancing advantage. Now, let's shift our focus to refinancing, which can be an effective strategy for managing debt, especially when it comes to loans with high interest rates, such as student loans. Here's why it's advantageous. 1. Interest rate reduction. Refinancing allows you to replace an existing loan with a new one, typically at a lower interest rate, reducing your overall repayment costs. 2. Lower monthly payments. Lower interest rates can lead to more manageable monthly payments. 3. Simplified repayment. Just like debt consolidation, refinancing can simplify your financial life by consolidating multiple loans into one. Here's another question from the audience.
The statement above, quote, "Now let's shift our focus to refinancing, which can be an effective strategy for managing debt, especially when it comes to loans with high interest rates, such as student loans." Unquote. I didn't know that you can refinance student loans. For some debts, you can file for bankruptcy. However, for student loans, you cannot file for bankruptcy. If you refinance a student loan, does the student loan become a non-student loan? After you refinance the student loan and you are still not able to pay the loan, can you file for bankruptcy for the student loan?
Refinancing student loans is an option that can make the repayment terms more manageable, but it's important to understand how it works and the implications. When you refinance a student loan. 1. Private versus federal loans. Student loans come in two main categories, federal and private. Federal student loans often come with favorable terms, such as income-driven repayment plans and loan forgiveness options. Refinancing typically involves taking out a new private loan to pay off the existing student loans. This new loan is offered by a private lender, like a bank or online lender. 2. Loss of federal protections. When you refinance federal student loans with a private lender, you may lose certain federal protections and benefits. This can include income-driven repayment options, loan forgiveness programs, and the ability to defer or forbear your loans during financial hardship. Once you refinance, the loan essentially becomes a new private loan. 3. Bankruptcy and student loans. Under the current U.S. bankruptcy laws, it is difficult to discharge student loan debt through bankruptcy. While it's not impossible, borrowers must prove undue hardship, which is a high legal standard. Refinancing a student loan does not automatically change its classification regarding bankruptcy. If you refinance and continue to face financial hardship, the bankruptcy process remains challenging. 4. Bankruptcy options. It's worth noting that filing for bankruptcy should generally be considered a last resort, and it can have long-lasting consequences on your credit and financial future. If you are facing severe financial hardship and considering bankruptcy, it's advisable to consult with a bankruptcy attorney to explore your options and assess your eligibility for discharging student loan debt. In summary, when you refinance a student loan, it essentially becomes a private loan, and you may lose federal protections. Bankruptcy is generally challenging for discharging student loan debt, both before and after refinancing. If you are struggling with student loan debt, it's essential to explore all available options, including income-driven repayment plans and loan forgiveness programs, and seek professional advice if bankruptcy is a consideration. If you found this segment informative, please consider liking and subscribing to our channel. Thank you. 4. When to consider refinancing. Refinancing can be a smart move in certain situations. Consider these scenarios. 1. High-interest loans. If you have loans with high interest rates, like student loans, refinancing can potentially save you thousands over the life of the loan. 2. Improved credit score. If your credit score has improved since taking out your initial loans, you may qualify for better refinancing terms. 3. Variable interest rates. Refinancing can help you switch from variable interest rates to fixed rates, providing financial stability. Another great question from the audience.
The statement above, quote, high-interest loans. If you have loans with high interest rates, like student loans, refinancing can potentially save you thousands over the life of the loan, unquote. So, after you refinance and get a lower interest rate, you can pay the minimum payment, or you can pay more since you have a lower interest rate so you have more income now, correct? Or you can get a second job and get more income so you can pay the loan off faster, correct? There's no penalty for paying off the loan early, correct? The sooner you pay off the loan, the better, correct?
You are correct in your understanding. 1. Lower interest rate. After refinancing to obtain a lower interest rate, you have several options for managing your loan more effectively. 2. Minimum payments. With a lower interest rate, your minimum monthly payments may also decrease. This provides financial relief for those who prefer to make minimum payments to meet their obligations. 3. Accelerated payments. Paying more than the minimum payment is a wise strategy. With a lower interest rate, a larger portion of your payment goes toward reducing the principal balance, which can significantly shorten the time it takes to pay off the loan. This not only saves you money on interest but helps you become debt-free faster. 4. Additional income. Using extra income from a second job, side gig, or any other source to pay down the loan is an excellent approach. The additional income can be applied directly to the principal, helping you pay off the loan more quickly. 5. No prepayment penalties. Many loans, including refinanced student loans, do not have prepayment penalties. This means you can pay off the loan early without incurring additional fees or charges. 6. Benefits of early repayment. Paying off a loan early is highly advantageous. It reduces the total interest you pay and provides you with financial freedom sooner. Being debt-free can open up opportunities for saving, investing, and achieving other financial goals. So, in summary, paying off a loan early is a prudent financial decision, and there are no penalties for doing so. Lowering your interest rate through refinancing is a smart strategy, and using additional income to accelerate repayment can help you achieve your financial goals more quickly. 5. Beware of pitfalls. While consolidation and refinancing can be beneficial, there are pitfalls to be aware of. 1. Loss of benefits. Some loans, like federal student loans, offer borrower protections and benefits that you may lose when refinancing. 2. Extending loan terms. Be cautious about extending the term of your loan. While it can lower monthly payments, it may cost more in the long run. 3. Qualification challenges. Refinancing and debt consolidation often require good credit and financial stability, which not everyone may have. While consolidation and refinancing can be beneficial, there are pitfalls to be aware of. 1. Loss of benefits. Some loans, like federal student loans, offer borrower protections and benefits that you may lose when refinancing. 2. Extending loan terms. Be cautious about extending the term of your loan. While it can lower monthly payments, it may cost more in the long run. 3. Qualification challenges. refinancing and debt consolidation often require good credit and financial stability, which not everyone may have. In conclusion, debt consolidation and refinancing are powerful strategies that can help you manage your debt more effectively and potentially save money. The key is to assess your unique financial situation and make informed decisions based on your goals and circumstances. Remember, there's no one-size-fits-all solution, and consulting with a financial advisor can provide valuable guidance. Stay tuned for the next segment, where we'll explore debt negotiation and dealing with creditors, an essential part of managing debt effectively. If you found this segment informative, please like and subscribe, and remember that the right financial strategy can pave the way to a debt-free future.